Hey Wizards, Sean here. Now in this video, I want to take you through some awesome Bitcoin trading strategies using options. Now a lot of you would have seen the recent video I did where I bought my first Bitcoin option on the Quedex trading platform, and that trade has worked out really well for me. So what I wanted to do was just to upskill that a bit, take it to a whole nother level. And in doing so, one of the strategies that I'm going to show you in this video is going to show you how you can not only protect your downside so that if the price of Bitcoin goes down, you don't lose as much money, but to also take instant cash out of the market in doing so. So let's get into it. So the first thing I want to give you is a fantastic resource. If you go to optionplaybook.com, there's an option strategies tab, and on that tab it lists out all sorts of cool strategies, and it shows you the profit and loss you'd make depending on what happens with the underlying price. So for example, the protective put, which the very first video ever posted on Crypto Wizards was about the protective put. So if you haven't seen that, go back and watch it. It's a cool video. But what it's showing you is that if the price of Bitcoin goes up, I'm making money. If the price of Bitcoin goes down, I lose a fixed amount of money. Here's my profit, here's my loss. This is the underlying price, and the blue line shows the P&L. So really useful chart. So straight away I can tell based on what is happening in the market, what's happening with the price of Bitcoin, comparing it to maybe some technical analysis, what sort of strategy might I want to try. Do I want a bullish strategy, a bearish strategy, or a neutral strategy? And so you can test this out to your heart's content. So I really recommend this as a resource. Now we're going to focus on two strategies today. One is the collar strategy. I thought that'd be good because it'll teach you about buying and selling two different options. And one is a covered call strategy, which is just very useful. As I mentioned in the beginning of this video, it's going to really open your mind as to the possibilities with options. So let's talk about some of these. Now, the first one I want to look at is the collar strategy. So the collar strategy is where we own the underlying stock, or in our case, Bitcoin. We're going to buy a put and we're going to sell a call, both out of the money. So first of all, the P&L looks very smooth, very neutral here, but in reality, option prices are all over the place. You've got different volatility rates. You might be placing a market order, so you might be buying at the ask or selling at the bid. So I want to show you how you can navigate your way through this and test it for real so that you can actually make money in the real world with Bitcoin using these strategies. So the first thing you want to do is head over to Crypto Wizards. When you get to the market scanner, just go over to the profile tab. Now, you don't need to be a paid subscriber to get this. All these tools are absolutely free. One of them that are optimized for you today is the Quedex Options Playbook. So you just click on that and you download that to Excel. When you do that, you will get a model that looks like this. So just click on reset. Now the reset button is very useful, by the way. So if you've tried something and none of it makes sense, or you think you got something wrong, just hit reset and it'll rebase everything for you. Now that you have this model, what you're going to be able to do is place up to 5 hypothetical trades, so different combinations, to try and work out what sort of position you will be at expiry in terms of profit or loss. So a really, really, really useful model. I mean, I've spent a lot of time developing this for my own use, so it works just the way I like it. So really hope you find this model useful, but it's going to be extremely useful when it comes to looking at the rates and volatility rates on Quedex. So that's the next place we want to go. So let's head over to quedex.net. And when you get to quedex.net, you just click on options. As you know, I like to go for the later expiries, and we're going to hit the options chain. So we click on options again. And now I have my options chain. So on the left, I have all my call options. On the right, I have all my put options. Really awesome user interface laid out here for me. And the strike price is down in the middle. Now, if I go back to the playbook, it says here I need to buy a put with a strike price of A. But before I do that, I need to own some coin. So the first thing we're going to do, we're going to go to our Excel model. We're going to click set positions, position 1. We're going to buy some coin. And the value that we have to pay for that coin, if I look at Quedex, it's about $9,500. So 9529 for the coin right now. So 9529. And I don't need to do any of this other stuff because we're just buying coin right now. So I'm going to add that in. So obviously, if you buy a Bitcoin, the price of Bitcoin goes up, you make money. If the price of Bitcoin goes down, you lose money. There's nothing fancy going on here, nothing outside of what you'd normally do if you just bought Bitcoin. But now we're going to get a little bit more technical and fancy. The second part of the strategy says to buy a put with strike price A. So strike price A is typically going to be below the current underlying value. So if the value right now is about $9,500, we probably want to look at about $8,500 as the strike price. So let's go and have a look at that. So I'm going to pick on 8,500, and it says here that I need to buy a put. So I need to be on the put side, $8,500. And if I'm buying and I'm placing a market order, so forget about limit orders right now. Let's just assume I want to buy this and place a market order, which I don't always recommend, but we're going to do it in this example. The implied volatility is about 178.4%. So what I do is I go back to the Excel model over here, set positions, position 2. I'm going to buy a put option. The underlying value we said was 9,529 and the exercise price is 8,500. Oh, one of the things I forgot, very sorry, we need to go to the 29th of June. I like the later expiries. I like to buy myself as much time as possible. So I'm going to look at the $8,500 strike price on the 29th of June expiration. And when I do that, the implied volatility is 158%. So $8,500, 158% for June the 29th, 158. I'm going to add that in. So you can already see, I don't need to close this window, by the way. I'm going to add a position 3 shortly. So click on position 3. You can already see that I've now fixed my loss. So if the price of Bitcoin goes down, I will only lose a certain amount of money. If the price of Bitcoin goes up and it ends up past this price level, so the 11,700 and something mark or 11,900 mark, I'm basically in profit. So I fixed my loss, but the price has to go up quite significantly for me to be in profit as well. So the next position that I want to place now is I wanted to sell a call at strike price B. So I want to sell a call option, so at say 10,500 as the strike price. Now, if I'm selling a call, I have to sell to the bid, so I'm going to sell with a lower volatility of 129%. So if we go back here, we saw I bought with a volatility high, 158, and I'm selling with the volatility low, which is like 125, 129%. So already I'm at a disadvantage because I'm placing market orders and the volatility rates I'm getting aren't favorable. But that's fine. The point of this model is for you to see that. And what I'm trying to show you is how you can navigate your way around so that you can find some sweet spots. I probably shouldn't say arbitrage, but you understand what I mean. $10,500 strike with a volatility of, let's just call it 131.9%. So 9,529 is the underlying position 3. We're going to sell a call option, $10,500, 2018, June 29th, that's still in there. And here we take it again, 128.5%. It doesn't really matter for the purposes of this model to get the percentages too exact, but just for this example, I will add the position in and exit. Now you can see, if you compare this to the playbook, you can see the same pattern, which is awesome. That means we're roughly on the right track. Now, it's not really in my favor because the loss section to me looks a lot wider than the profit section. And the reason for that is because of the volatility. If I got the same volatility with the put that I was buying, I would actually be in a favorable position. My risk to reward would look quite favorable with this. So this is really useful. This tool is so useful because it shows you based on the volatility rates. It shows you what sort of profit and loss you would be looking at if you amalgamate all these trades. So really useful. I hope you get so much use out of this tool. For those of you who are wondering that the prices look different to Quedex, because here I'm working in dollars, I have got some Bitcoin prices built in here. I haven't fully optimized it yet, but I have checked the pricing here against the model that Quedex provides as well on their website. And I can tell you the dollars tie back exactly. And the reason for that is because both models use the Black-Scholes model. If you don't know what that is, or if any of this is confusing you, make sure you go back and watch the video that I did on options, the introduction to options for beginners, and then this should start to make a lot more sense to you. So that's a really cool strategy. I'm gonna hit clear all. And now let's go and look at the next strategy. So if we go to the option strategies, I wanted to take you through the covered call strategy. This is a fascinating strategy to me, and it's a very popular one as well. Okay, so the very first thing is we own the stock or we own the coin. So if I go back to Quedex, the price is about 9538. So let's just assume that's the price I pay. So position 1, I'm going to buy some coin at 9538. I don't need to put anything else in. Same as before, price of Bitcoin goes up, I make money, price goes down, I lose money. The next thing we wanted to do was we wanted to sell a call at strike price A. So strike price A meaning either at the money or just out of the money. So if we go to Quedex and now want to sell a call option, we know we're at about $9,500. In fact, Bitcoin's price has gone just a bit above that. So let's assume that I'm going to sell a call at this price, and we're looking at selling with volatility at 126% at $9,500. So let's set position 2, where we're going to sell a call option. The underlying value is 9538. The exercise price is going to be 9,500 with an expiration of 2018, June the 29th. And volatility, I need to check that again, was about 126.2%. And I'm going to add that in. Now this is fascinating because we know the price of Bitcoin right now is about $9,500. But check what happens at expiry. If the price goes below $9,500, in fact, if it's above this sort of 6,800 mark level, I'm in profit. So even if the price drops some by, another couple $1,000 nearly, I'm still going to be in profit. If the price goes up and it rockets up, I make a fixed amount of money because I've sold a call option and I'm liable for that option, but I also own the underlying asset. It's very similar to that house example we used when we were talking about the introduction to options, where the owner of the house gave us the rights to buy the house. We are that owner of the house in this example. Now, if the price goes significantly down, we lose money. Here's the interesting thing, and the useful thing with this model is I can set this back to none. So now removing position 2, we can see if the price goes down to say $5,000, I lose about $4,000. If the price goes down to about $1,800, I lose nearly $8,000. So let's put that option back in. Well, if the price goes down to nearly $1,800, I only lose $5,000 now. So not only have I increased my probability of making a profit, and a healthy profit at that, because I'm taking this cash out of the market immediately. When you sell, I'm the seller. So give me the cash, here's the option, right? Not only have I done that and increased my probability, but I've also reduced the amount that I'll lose because of the money that I'm taking from selling the call option in the first place. So it's a really useful strategy. Now, getting back to Quedex, the way that you would trade this is you just go to the options chain. If I wanted to say buy my put option as an example, I would have to click on the put side with the strike price. So anywhere on this row, if I click, it'll take me through. With the call side, it's the same thing. So let's just click on puts for 8,500. Now what Quedex does is it already gives you a profit and loss chart. And this is really useful. It saves a lot of time. You don't then need this Excel model, etc. The only reason you'd use the Excel model is if you're amalgamating a lot of trades. But here, if you're just going to buy one or sell one option, then this P&L is really useful, and frankly, it's all you need. So really awesome way to do it. And then your different strike prices are here at the top. So you don't even have to go to the options chain. You can just go to the chart and pick your expiry or which strike price you want, etc. here. Once you've found that, then you have the order book. And you can see the bids and the asks and also the implied volatility. So let's assume that I want to sell an option in this case. I would copy the bid over here, and the implied volatility is 128.2%. So it tells me down here as well. Now, the minimum amount that you can trade, and somebody asked in a previous video, and I thank you for that. What's the minimum you can trade? Well, there is no minimum. One contract is $1, so I can hedge say $500 worth as an example. But the minimum that you can withdraw is 0.01 Bitcoin. So that's just some information that you might find useful. So what you're really going to love about all of this is you have a useful tool that you can just implement and test out different strategies. It can help you solidify your understanding of how options work and theoretically what would happen should you place different trades. You have this amazing user interface by Quedex. Now, you know I bought my first Bitcoin option with Quedex. It was because Quedex was recommended to me by one of our subscribers here on the Crypto Wizards channel, and I loved their user interface. And that was before Crypto Wizards took on any affiliation with Quedex. Now, for those of you who are new to this channel, Crypto Wizards is affiliated with Quedex, so you get 10% off if you use the link in this video. You don't have to use the link. If you click on the link in the Excel model trade on Quedex, that is an affiliate link. So if you choose to use Quedex without using that link, it's absolutely fine. It just means that if you use the link, you get rewarded, Crypto Wizards gets rewarded, and Quedex gets rewarded. So it's a win-win-win situation. Anyhow, I hope you found this video really useful. Remember to let me know what your questions are in the comment field. And until the next video, talk soon.